What's good, y'all? It's HB Punch and Profit. We're going to break down price action in the Nasdaq for the New York session, February 11th, 2025. But before we get started, like the video, comment down below, subscribe if you're new, turn on your notifications, helps the channel grow, helps me find time to provide you guys with free content. So first things first, we're going to look at the higher time frame. I get on the charts roughly at 9 a.m. I look at the daily 4 hour, 1 hour, and I'm seeing bullish order flow initially, but that's why I don't like having a hard bias for the day, because as you see up here, as we exhaust, I reevaluate when we get roughly up here, and I go back on the daily to 4 hour, 1 hour, and I'm seeing possible opportunities to sell. And then there's another opportunity to buy later on if you keep on assessing. So that's why I don't really like having a hard bias. It usually that doesn't mean there won't be days where it won't be purely bullish or purely buys I'm looking for or sells. It just depends on the higher time frame order flow. But in this case, I was seeing that the higher time frame was neutral, meaning that there were going to be buy and sell opportunities. Two, we're going to look for our inversions. Our signals are inversion and advanced market structure shift. Inversion will be highlighted in an orange box, roughly speaking, and the advanced market structure shift will be in a blue bolded line. Four, we're going to place our stops at the swing lows or highs, especially if you're new or you're transitioning from a different style of trading. I would recommend using 1 to 2 micros and putting your stops at the swing highs and swing lows, so you can get the repetition and see what's happening in the charts or with the signals. And when you get it good at it, you can start tightening up that risk, especially when you start to develop a deeper understanding of price action. This is a very simplistic version of what I'm teaching just to get you started. As the channel grows, I'm going to start showing you a little bit more, as I will do today. I'll show you a little something to manage your risk a little bit better. So stops at the swing highs and swing lows, or it can be at your discretion. Remember, trading doesn't, the way I trade doesn't need to mean you need to trade exactly like me. There's not a one size shoe that fits all in trading. So if you can find a way to manage tighter risk, okay, before I come out with all my tips and tricks, you can have a tighter stop. Okay, it's at your discretion. Five, take profit at least a 1 to 1 or more. And same thing with number four. You can put it at your discretion. It's your choice, but I would advise at least a 1 to 1. So roughly at the 9:30 opening, we get this inversion, and we're going to highlight where the bearish gap was. There's a volume imbalance in this gap right here. So we're going to take that and bring it down, mark that out in red, indicating a bearish gap. That was the bearish fair value gap. This is the bullish fair value gap, two volume imbalances between it, right? So we're going to put at the candle body, two candle bodies, since there's two volume imbalances in this bullish fair value gap. So you see where the overlap occurred. We take that off. We mark this out in orange. That's where the inversion roughly happened. We're going to put our advanced market structure shift at the candle body high right here, the candle body fractal high. And if you're trading at the 9:30 opening, for more experienced people, I would recommend putting a buy stop or a sell stop at the advanced market structure shift. It's a little bit risky, but knowing the opening, you get these volatile moves, things happen fast, you get tapped in quick, you get to your marker and you hit it, instead of maybe the move already happens, you put your limit order and it comes back and knocks you out, or you just get left behind. In this case, I'm not sure if a limit order worked. I put a buy stop. So that was the first trade, and it was a massive one. And even if I kept my stop at the swing low, which was right here, this thing gave you at least a 2 to 1. Now, it doesn't mean you're going to get this whole move, but if you go down to a 2 to 1 risk to reward, you would have gotten 126 points, even with your stop at the swing low. And I know people think, oh my God, a 60-point stop, that's insane. How can I have a 60-point stop? Well, you can't over leverage. You can't use a mini. You got to use 1 micro at most, maybe two. 1 micro, 60 points, that's about 120 points. Okay? 120 points, that's not that big of a deal. Most of you will put 5 minis, okay, with the 2K account, and trying to get rich all the time, and you blow out your accounts in one trade. So 1 micro for $120 is not that big of a deal. And if you want to go up to two, what's that? That's about maybe 250, $300 of risk. And the cool part was you didn't even take any drawdown at all. Okay, you had this massive trade. So that was the first move. Oh, and one more thing. Like I said, as the trade is playing out your favor, it doesn't mean you need to keep your stop down here. You can move it just below the inversion, just above it, or keep it from the advanced market structure shift a certain amount of points. Me, at the lowest, I would probably go, or if I wanted to tighten up, maybe I'd stay below the inversion. Okay. Or like I said, you can start at the swing low or swing high, and as the trade's playing out, start to tighten it up. And you will figure out how to tighten up the risk as you get better. But the reason why I want you to leave that big stop and have low leverage with one micro, so you can see the signal, let your trade play out, let it breathe and get confident. And as you become more confident and you see the signal, then you can start, you know, altering that stop and making it tighter. All right, next signal, we get on the higher time frame, roughly around here. We're starting to see opportunities that we can possibly sell. If a signal presents itself, we get a bullish fair value gap right here. Let's zoom in. There's a volume imbalance, so we're gonna put it right, start from there. And two volume imbalance in this bullish fair value gap. Mark that out in green. We get a bearish fair value gap right here. Okay, we're gonna put it right there, red, mark it out. That's where our overlap occurs. Boom. Take the green one off, color this in orange to highlight where the overlap occurred, roughly speaking. We wait for this candle body low to get closed below. Where does that occur? Right here. Now I'm going to show you multiple ways to manage this, but I'm going to show you the basic fundamental way to take this trade if you're a beginner or transitioning, and this is how I recommend you take it if you do it. Now you get your inversion, you get your candle body close of the advanced market structure shift. This one you got to deal with some drawdown. Right after this candle body closes over the blue line, you have to deal with 21 points of drawdown. Now that's not a big deal with one micro. That's only what, 40 points. If you got two micros, that's 80, or I'm sorry, $40. Two micros, $80. Okay, that's nothing. Now let's see the risk to reward on this. Even if, let's say, even if you kept your stop all the way up here, let's see if it offered you at least a 1-to-1. Went up all the way to a 2-to-6, so you could have gotten a 2-to-1 risk to reward off of this. 90 points. Okay, 90 points. Now what we do from here, okay, like I said, tighten up that stop as the trade plays out. So maybe you want to go up just above the inversion, just fine, just below it eventually as the trade's moving down, and then break even. But starting off low leverage and just get used to this playing out. Okay, another way you can do this if you want to manage a really tight stop, what you can do is put a 10-point stop for all of your trades, all of your signals. Now, get your candle body closed, you put your limit order in at the blue line, and the thing pulls back on you immediately. You get stopped out. No big deal. You only lost 10 points. Even with the mini, it's not too bad, even though $200 can be pushing it a little bit. We're going to pull out where the inversion occurred or where the last gap happened on this leg. So let's delete this for a second. Where is the last gap that occurred? You get your inversion, you get your advanced market structure shift with the candle body close, but you get a nasty pullback that goes more than 10 points. Where did the last gap occur on this leg? So let's point that out. You get stopped out and you're like, man, the signal, it gave me the signal, inversion, advanced market structure shift. Why is it pulling back so deep? Okay, because it wants, if it pulls back that deep, we point out that bearish, the last gap that happened on this leg. And what are we going to do? We're going to put a limit order at the consequent encroachment, or you can put it for the fill of that gap. Sometimes you don't get filled and it shortchanges you, so sometimes I'll just put it slightly above the consequent encroachment or the consequent encroachment of that gap. And then my stop, either it can be at the swing high for 24 points, or it can be at the tail end of that bearish fair value gap, which would have been roughly right here. 1, 2, 3, that's where our gap occurred. So I'm going to put it at the wick. Okay. of that first candle of the bearish fair value gap right here. Okay, just to give it some breathing room. Or I can go to the candle body, okay, of the first candle of the bearish fair value gap. That's usually a nice place to put it as well. You just want to give it a little bit of breathing room. Sometimes you gotta get a wick up. And then, okay, this could have offered you potentially, look how crazy this is. Now, like I said, doesn't mean you're going to catch all this move, because you can't really predict that perfectly all the time. But it could have offered you a 13 to 2 risk to reward. Okay, could have offered you that. And that's why, if you want to manage tighter risk, you will lose more. And that's why I say you will lose more, because you're going to get pullbacks. Okay, but if, let's say, I'm going to have only 10 points of drawdown on each of my signals. Okay, you get stopped out immediately, and then I want you to reassess and say, okay, I got my signal, everything showed. So what's happening now? This is a little bit high resistant initially, and it's probably looking to tap into a gap of that leg. Sometimes the gap can be up here, it can be up here. In this case, it was right here. Notice there's no other fair value gaps, okay, in the leg. This is the only one we have up here that needs to get filled. And if you have multiple, you go to the highest one and wait for that to get filled. Okay, so what happens? We pull back, we wick into this gap, and then we continue our descent down. Another pullback because it's high resistance. And where does it go? Check this out. It fills the gap, or touches it. Wants to fill it with the wick, right? It just wants to, it's almost like it needs to touch that gap, okay, with the wick, and then it goes down. All right, so that's when you have high resistance, that's all you want to do. If you get your signal inversion, advanced market structure shift, holy shit, boom, I get stopped out. I have a 10-point stop. Where is the highest fair value gap? Okay, I'm going to put a limit order at the consequent encroachment. Okay, stop at the high of the wick, roughly here, or the candle body. We'll put it at the wick for now. Okay, and boom, you get beautiful risk to reward right here. And that's one way you can get with minis, right? Even then, still, I mean, 10 points of one mini is about $200. That's a lot of money to lose on the day. So many ways to kind of scratch the cat, or skin the cat, excuse me. And that was a beautiful trade that played out. Let's see if there was something to the upside back here. I wasn't playing at this point. Looks like you get an inversion right here. Okay, I'm not going to zoom into this one. You get an advanced market structure shift. And guess what? If it gives you more than 10 points of drawdown, let's see. Okay, this one, see, 10 points. We could have put our stop at 10 points and we would have been fine. Put our limit order at the blue line, 10-point stop. Okay, and this could have potentially offered us a 5 to 9. Okay, yeah, I'm sure you can figure out how to get a 2 to 1 at least out of this trade. So you get that inversion. There's a bearish fair value gap in here, bullish fair value gap, advanced market structure shift. You keep a 10-point stop all the time. This one comes close, but notice, where does it gravitate towards? Where, before it makes the big move, what does it want to do? It wants to wick. It's not filling it, but it's wicking down to kind of like rebalance and regroup, and then boom, it goes. Fortunately, it didn't go past 10 points. Now let's go back to the original trade right here. This one, I would have to see how it played out on FX replay. I don't know if we got a candle body close and it created this wick, but let's see if it was more than 10 points from the advance. No, see, 10 points hold strong right there. So if you kept a 10-point stop, you'd have been gold, man. 10-point stop, just barely, just barely. Let's move it over. 10-point stop, just barely. Massive risk to reward. So that's one way. I'm giving you guys a little bit of gems now. graduating a little bit as the channel grows. That's one way you can keep tighter stops and manage your risk. But you will lose more. But if you're calm and composed and consistent and you're willing to take a small little loss, you will recover easily with massive risk rewards. If you're, say, you have a 5 to 1, okay, or you have a 5 to 1 risk to reward, and you're only risking 10 points, you will probably lose a few trades, but that 5 to 1 will regain all that money back as time goes on. So this is HB. Punch a profit. Comment down below, like the video, subscribe if you're new. Peace.